Hi, and welcome to this chapter, bullish or bearish divergence. This, simply put, is a contrast between the direction in which the market is currently moving and the indicated volume on the chart. We cannot have price moving upwards in an uptrend and simultaneously have decreasing buyer volumes. This is an indication that the market is about to reverse. It's a telltale sign. We at FunFXC use the AO Awesome Oscillator as the instrument to measure this volume. It works pretty simple. Volume above the zero line is buyer volume, and volume below the zero line is seller volume. This can be expected at the end of a bullish cycle for bearish divergence. As you can see, we have a bullish cycle, which is a bullish trend, which is an uptrend, where it makes a low, a high, a higher low, a higher high, a higher low, and makes a topping formation with the double top. On this top information of the double top, we can actually see that the volumes have decreased, but the volumes have decreased above that zero line. That zero line indicates to us that it's in an upward trend, but the volume itself to meet the same point as what it did previously is now less. So you have to, the key for this is to find a topping formation and then look for the actual decrease in volume. Now we have a bearish divergence. This can be expected in the end of a bearish cycle. So we have a downtrend or bearish trend where it makes a high, low, lower high, lower low, lower high, lower lows, lower high, lower lows, and eventually makes a bottom formation on a triple bottom. On this triple bottom, you can actually see that the volumes to meet the same point previously have each time decreased. This tells us that they're lining up for new buys. In other words, it's still below the zero line, which was the downtrend, yes, but the volumes itself had decreased, indicating that there's less and less buyers in the market, less and less sellers in the market, and more buyers. And until it crosses zero factor, we actually look to buy. But let's go into further detail on the actual chart so you can see what we mean. So, first of all, we need to add our indicator. So we have to go to Insert, Indicators, Custom. You can either go to one we gave, which is it's MACD4C, but we can rather use a Bill Williams one, which is the Awesome Oscillator. And then you simply go to Lime to match all the colors, and you press OK. Now you can see it appears on your chart as that there. So you can change this by moving this up and clicking the white line and moving up and down. Ideally you want it 20% of your chart size so it looks nice and proportional. So once that's added, we can now go look for divergence. As we mentioned before, this was a sequence of a downtrend and this is a sequence of an uptrend. So let's go find where the divergence actually occurred on our chart. So in a downtrend, which is a bear trend, we'll be looking for bullish divergence. It's essentially the chart telling us that it wants to move in a different direction. That's all it's saying to us, is that sometime soon I want to move. As you can see, a lower high, a lower low, lower high, a low. Now the trend itself started to shift here as well. But on the volume on the indicator, it will also tell you this to give you a definite confirmation. So, as you can see here, we have a left shoulder, a head, a right shoulder. This is a head and inverse head and shoulders pattern. This is a pattern telling us the candlesticks would like to change. On this, we can obviously now see that the bullish divergence is occurring, and we were in a downtrend, so we can now expect an uptrend to begin. On this, we would like to see some form of definite break higher, as we have had here, and then we can see the moves gradually building upside. So with this, let's move on to the next example, which is obviously bearish divergence. Bearish divergence is an occurring of an uptrend into a top information. As you can see here, we have divergence that occurred there with the drop. Furthermore, we'd like to see one more little move up here, so we have continued divergence, but obviously that will come at its due course. But for now, there is divergence. That was divergence there, which gave us a definite drop. So let's recap on what bearish divergence is. Bearish divergence is found in an uptrend. At the end of an uptrend, we'll have divergence which confirms the actual top information. On this top information, we can see the divergence occurring where the volume itself becomes less and less and less, and eventually goes below the zero factor here. You can add this horizontal line if you like. Just double click on it, right click, horizontal lines, you go to parameters and you press 0 and then you press OK. As now you can see there's your 0 line. So now you can see that once it crossed below the 0 line, it was a confirmation of the sells. We had the divergence across the 0 line, and that was the confirmation of the sells, just purely using the actual indicator, the awesome oscillator. So recap from one more time. A bearish trend will have bullish divergence because it was in a downtrend and it wanted to signal to us that it wanted to turn into a bullish trend. So we'll have to form bullish divergence before it makes that uptrend. Then we get bearish divergence, which comes at the end of an uptrend. The divergence has to occur, and ideally a 0 drop below, and then we can look for sells. So that's very simple, guys. That's bullish and bearish divergence, and let's see if you guys can manage to do that, because it's very simple and it doesn't take much practice. You just need to go to your charts and start identifying these things. One little clue we can give about this is that we need to start identifying daily divergence first. Weekly and daily divergence is more powerful than 4-hour divergence. Even though 4-hour divergence is still reliable, daily and weekly divergence is probably the better one to trade with. So with that, guys, you can move on to the next chapter.